Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The other real valuation, I guess you could look at in terms of defining a value at a point in time is this idea of purchasing power parity. Now, purchasing power parity is simply a measure of saying that in a world in which all prices ultimately should be the same, what does a dollar buy across the border? For example, if we go to Europe and the dollar buys 30% less in terms of purchasing power than the euro, meaning if it takes you 30% more dollars to buy the same amount of goods you can in the US, and the euro is going to tend to be 30% overvalued on a purchasing power parity basis. So the purchasing power parity basis tries to evaluate currencies across borders. How is the valuation relative across borders for the same amount of goods? And that's the goal of purchasing power parity. Now, ultimately, that's not something we can trade off of, but it is something we have to keep in mind because over time, again, over the long term, currencies will tend to flatten out purchasing power parity. But this may be measured in years, but often I think it's a good representation of sometimes extremes. That's where we use purchasing power parity. When you see things that are 25, 30% over or undervalued based on purchasing power parity, you have to start paying attention if you're a longer term trader. Again, if you're trading in very short or narrow time frames, you're not really going to be too concerned about purchasing power parity. This is more for investors or longer term investors in currency, this measure, but ultimately, again, it's just something to keep a handle on. Right now, I think the latest we saw, the euro is probably about 25% overvalued relative to the US dollar on a purchasing power parity basis. Does that mean the euro can't go back to 160, 147, go a lot higher? Absolutely not. But it means over time, on a relative basis, there are some dislocations and some inefficiencies in that market, or there's just some, just relative demand and all kinds of other things in the marketplace at a point in time that have made the euro overvalued on a purchasing power parity basis. So again, look at it from extremes. Don't necessarily use it for a trading vehicle, but it does give us a relative understanding of real value of currencies across the globe on a long-term basis. One of the problems we always run into is this idea that we think we know something that's going on in the market. We think we know it and nobody else knows it. The reality is that if we know it, probably everybody else knows it, or most people who make big portfolio decisions know it. So you have to believe that things that we do know in the world or think we know that are discounted in the price. That's what market prices do, and especially currencies. They discount very, very rapidly because it's a global product, and you have people at desk all over the world discounting and making these decisions very, very quickly. And that's often why you'll see currency prices move before you'll see news events hit screens, because of the fact that currency prices are created on interbank desks and screens all around the world. You're going to get really very close to the action information flowing in the currency prices right away. And in general, this idea that currency price discounts things out there, we have to keep in mind. We can't think we have a piece of information that nobody else knows and it's the Holy Grail. So it's a little disconcerting when you think of that. Okay, what do we do here? Where is the jewel of currency investing? Not sure if there is one, but hopefully we'll give you a little bit something to think about here. Ultimately, the goal in terms of trying to judge where the currencies are going is this idea of setup conditions. You're trying to just evaluate some of the background reality of setup conditions, of what the market expects. There are things that you can have a real understanding about where things are now and have a general indication of what the market expects in this idea of shift in real interest rate yield differentials, and I'll explain that. The goal here really, I think, is to help you really to try and determine the underlying trend. And do the existing setup the conditions, and do the existing interest rate conditions justify the underlying trend once you add in one more condition, which is sentiment. And we'll get to that in just a second. Here's the equation. If we had to define an equation of what we're trying to solve for, what drives currency rates, it really is this simple. What drives currency rates is people in the market's expectations of the total return from buying that particular currency. And of the real factors that we know about, we only know about one thing at the moment, and that's interest rates. We know if we buy a particular currency, we're going to get paid a certain interest rate or a certain yield at that point in time. That really is the only thing we know. But we're betting on a capital appreciation in that particular currency. So in effect, we're trying to solve for something where needless to say, we don't have the rest of the equation. It comes down to the expected total return is your interest yield plus the capital appreciation in the currency that you're buying. And I know that sounds strange, but ultimately that is the problem with currency evaluation over time and valuation and currency trading. This idea of the second part of only knowing interest rate and what are all those factors that are going to drive that capital appreciation or that a future exchange rate is all the stuff out there that we try and work on and think about and create rationales, both valid and invalid rationales, and irrational and rational reasoning to try and figure out. If you look at this, and again, you can read people like George Soros. His book is Alchemy of Finance, and he talks about currencies in a way I think is really a reality-based view of currencies, more so than anybody really ever has. And he wrote the book back in 1986, and I go back to that a lot. He just makes the point ultimately that speculative capital is attracted by rising exchange rate and rising interest rates. Interest rates we know. Ultimately, the value of the exchange rate or the rising interest rate in this, or value of the exchange rate, in this equation, capital appreciation in the exchange rate is much more powerful even than the interest rate, because it only takes a small move in the exchange rate to wipe out the gains you may get on the interest rate side of the fence. Same token, if you get this right and your relative interest rate is high and the capital appreciation you're gaining in the exchange rate is going in the right direction, you can see how this can be very self-reinforcing. And that's what happens in currency markets. And I've said this before, more so than any other markets, they become very self-reinforcing just because of this process. The idea of getting it right and getting that capital appreciation, that future exchange rate right, tends to feed the trend and bring more money into the trend. And I know it sounds odd, and I know it sounds simplistic, but ultimately all this stuff we do and all this stuff these analysts do is to try and figure out that second half of the equation that's going to be the driver there. Of course, we do a lot of stuff to try and figure out how the first half of the equation, the interest rate, is going to change. And the problem is we can't forecast interest rates, and I'll get to this in a moment. We can't forecast interest rates, but what we can do is try and figure out what the consensus thinks about it, and that is the best we can do, is get a handle on that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.